Hey guys, welcome back to my channel, Sharehost Talks Investing. So in today's video, I'm going to discuss the reason I decided to change my investment strategy after just 2 months of investing. But before we get to that, can I kindly ask that if you're a new viewer or returning viewer and you haven't already subscribed, please hit that subscribe button below because it really does help a small channel like myself grow. And also one last thing, if you're starting on your own investment journey, I have a link for my Trading212 app I use below. And if you use that link and deposit £1, both you and myself will receive a free share worth up to £100. Yeah, make sure to give it a go if you're thinking of investing. Okay, so let's get started. So I started my investment journey at the beginning of November 2020. And before I started, I had very little knowledge about investing and all the different kinds of companies and platforms to use, etc. So I did a lot of research and I followed a lot of fellow YouTubers and watched their videos to try to understand exactly which sort of companies I should be investing in. And what I noticed was that a lot of my fellow UK YouTubers were investing in a lot of dividend yielding companies or blue chip companies. So obviously watching this, my understanding was these were the sort of companies I should also be investing in. And so I really took a leaf out of these YouTubers' books, and those were the sort of companies I focused on. And I didn't really understand that maybe their situation was different, their risk tolerance was different, etc. I just thought, okay, these are the sort of companies I should be investing in. So when I first started my portfolio, that's how I picked my initial stocks. So now let's look at examples of some dividend paying companies. These were the sort of companies I invested in initially, and I'll discuss why I felt that these sort of companies weren't right for me. So if you go in the search function in Trading212, click stocks and hit dividend. Okay, now as you can see, there's a list of dividend paying companies, and if we just as an example click on AT&T. Now AT&T pays a dividend yield of 7.13%, which is a really good dividend yield. And yeah, so as an example, when I initially started, AT&T was one of the companies that was actually in my portfolio. Now if we look at the all-time chart for AT&T, as you can see, the share price has fluctuated quite regularly. So it's had its ups, it's had its downs, but because it's paying a healthy dividend, I guess that offsets the actual share price, whether it's going up or down. Because if you've got a decent amount invested within that company, at least you'd be paid a regular dividend. But now the problem I had with this, and I figured this out a lot later, was with the small capital I had and the amount I was putting in monthly, I just felt like it would take such a long time for the dividends to actually become meaningful. And I know, every small amount of dividend, if you reinvest it, it helps the, your portfolio grow and it has a snowball effect. But the way I was looking at it, it would just take such a long time investing, like even a 7% dividend yield, which is very high, would take such a long time to be meaningful in a company like AT&T, which again, as you can see, the share price is fluctuating. So even if I'm reinvesting at that 7%, I mean, it's not a high growth company either. So, even if I'm reinvesting it, it's not gonna, make the value of my investment much, much higher over like say a 3 to 5 year span. And I mean, the dividend yield again would be so small. I mean, not the yield, the dividend value would be so small just because of my, portfolio, because, I don't have huge sums to invest at the moment. From my understanding, is that for me personally, it just wasn't the right move to, invest in dividend yield companies like AT&T. And there's numerous companies, that pay good dividends. And for certain investors, it may be the right sort of company to focus on, or companies. So, these high dividend yielding companies, to help you grow your wealth. And then what I did was I actually sold all my dividend yield companies. And I'll actually discuss the companies I began to focus on later on in this video. But yeah, just to confirm, I did sell all my dividend yield companies, and in my month 3 update video, you'll actually see the new companies I've invested in, and there's some very surprising results. So if you want to stay tuned, make sure to hit the subscribe button so you're alerted the next time my month 3 update video comes out. But that doesn't mean I'm just giving up on dividend yield companies. Like I said, I changed my investment strategy. So, at the moment, I'm not focusing on dividend yield companies. But once I grow my portfolio and, it gets to a substantial level where I can actually earn a nice, steady income from dividends, at that point, I will begin to start investing more in dividend yield companies also to protect my investments. Because usually dividend yielding companies, they're very stable companies, because to be able to pay a dividend, the company needs to have a healthy balance sheet and to, pay the shareholders. So yeah, going forward, I'm not focusing on dividend yield companies, but in the future, I will change my investment strategy to, slowly begin to focus more on dividend yield companies. So the next set of companies, I also was previously investing in were like these blue chip companies. And when I talk about blue chip companies, these are like the Amazons, Netflix, etc. So these are the companies that, they're not exactly paying a dividend, but, they're companies that, regardless of what situation may happen, they'll most likely always be around. So yeah, I was investing in these companies, and realistically, these are companies that are not gonna grow massively. So if I actually go into, talking about Amazon, if I just go onto Amazon, and as you can see, since 2013, it's gone up by 1,157.79%. So yeah, almost an 11 and a half times growth over 7 years, which is a really great growth. But a problem with investing in a company, for myself personally, like Amazon right now, is at the moment the market cap of Amazon is 1.56 trillion. Now, if I was to begin investing in Amazon, I realistically don't believe the market cap of Amazon is gonna be able to double over a year, or even double over the next 2 to 3 years, because as these companies get so large and the market caps get so big, it becomes much harder for a company like that to grow. Whereas if you're investing in a company that's a new company that's in the earliest stages of growth, so in its infancy, so it may have a market cap of only 20 million. It's a lot easier to go from 20 million to 40 million than from 1.56 trillion to almost 3 trillion. Yeah. So, again, there's nothing wrong with investing in a company like Amazon, because I feel like companies like these are great for protecting your wealth. So, wealth preservation. But for my own personal investment strategy, they weren't right for me to grow my current, limited funds I have. So yeah, again, great company Amazon, and these blue chip companies are great investment for some people. But as I said initially, when I started, I was following fellow YouTubers, and all their portfolios were full of like these blue chip companies or these high dividend yielding companies. Now I just want to clarify, in no way am I saying my investment strategy is the correct strategy, but what I feel like it is correct for me in this moment in time. Just the other way, I'll say that doesn't mean you should blindly follow me and my investment strategy. And the same way, all these other YouTubers who are also, showing you their investment portfolios, don't just blindly follow those individuals. It's great for, watching their content or my content, just to inspire you as to, get ideas as to the sort of companies or strategies that are possible. But always do your own due diligence. And I think that's one of the big learning points for myself, was doing my own due diligence and not just blindly following what other people are doing. And because of that, I've really changed my investment strategy. So currently, I'll talk about what my investment strategy is. So I'm no longer focusing on those blue chip companies or those high dividend yielding companies. So what I've instead begun to do is I've begun to more invest in companies that are in the infancy. So, companies that their share price is under $10, and I feel like there's potential for those companies to grow much larger. So I'm trying to get those companies that have a market cap of under like 3 to 400 million. but I feel like there's a potential scope to grow. And as an example, one of the companies I've invested in, um, I'll actually search for it, is a company called Gevo. Gevo is in the renewable space. And as part of my investment strategy, the reason I'm invested in a company like Gevo is because, like I said, it's in the renewable energy space, and my new portfolio going forward is going to focus, like I said, on these high growth, low market cap, companies, which I feel like have a potential to grow massively over the next 5 to 10 years. So the sectors I'll be looking at are in the renewable energy sector, the EV sector, and the healthcare slash pharmaceutical sector. So I'm not going to go into detail about Gevo. I can do that at a later video and actually, describe why I've invested in Gevo and where I think the growth is, etc. And even show you some of the fundamentals about it. But I will show you, at what point I began investing in Gevo, at what share price it was, and where it's currently, and where I think it can go to. So I started investing in Gevo around, I would say, toward the end of November. No, sorry, it actually was, I think, early November. So yeah, when the share price was around $1. So at that point, I began investing in Gevo, and the reason for that was, like I said, it was in the renewable energy space. I, did my due diligence, and I liked what I saw, and I thought it was massively underpriced. So these are the sort of companies I'm looking for. Those that are undervalued. I feel like there's much potential for them to grow. And, again, this is a sector that's going to, in my opinion, explode in the next 10 years. So I want to get in early on, the EV sector, the, renewable energy sector, and even the pharma sector. I think has a lot more eyes on it ever since the COVID situation. So yeah, these are the sectors I'll be focusing on. And as an example, like I said, I started investing in Gevo at $1. And now, as you can see, the share price is over $10.50. It's had an 8.5 times growth. And what I've done is, because I believe in it, I've actually been averaging up. So, again, I'll actually show you this in my next portfolio video, what my, Gevo investment is worth now. But let's just say I'm quite happy with where it's at. So, and it's not just Gevo. I've got other companies in my portfolio. Look, when I change my strategy, I've been performing very well. So definitely make sure to stay tuned for my next video update, where you'll actually see some very surprising results. But yeah, so as mentioned, Gevo's doing very well for me, and again, this is my new investment strategy going forward. It might not be the right strategy for others, but for me, it is. So yeah, there's been some massive changes, and it's only been approaching 3 months since I've been investing. So again, I'm still learning the ropes. I'm in no way an expert on this, as I've previously mentioned. So as always, guys, do your own due diligence, and I hope you like this video and an honest take on exactly like where I was at 2 months ago, the sort of companies I was investing in, and how I've actually changed track almost completely and gone the other way to these high growth, more risky options. And that's one thing worth mentioning. These companies that I'm investing in, it's not all upside. There's a lot of potential for these companies to, also potentially go bust, because again, they're so volatile, because they're so like undervalued, and some of them may be in debt. Again, this is where your due diligence comes in. So you've got to look at the balance sheets, you've got to look at where they're heading towards. So again, these sort of companies are a lot more risky than investing on those stable blue chip companies that, again, almost anything could happen and they'd more or less always be around. Again, there's a lot more upside if you get these companies, because a company like Gevo, where only $10, I wouldn't be surprised if by the end of this year this company is worth $40 to $50, and within the next 5 years, I actually expect Gevo to be one of the leading, companies in renewable biofuel, and I wouldn't be surprised if in the next 5 years this is a triple-digit company, and and I'm talking like maybe between $200 to $400. I mean, it really does have that kind of potential, and I would have got in early, so you can imagine how massively my investment would have grown over that time. Yeah, I hope you enjoyed my video. And please, it really does help me if you hit that like button, leave a comment, and let me know what you think about my change in the investment strategy. How does it compare to yours? And as always, please hit that subscribe button because I'm a small channel and it really does help me grow.